My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do, my friends. I'm just trying to make a little money. My job, not just to entertain, but to explain everything. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. When you watch those debates, when you hear the rhetoric around the presidential election, there's really only one issue that pervades the discussion, right? And it's inflation. I know the Federal Reserve has done its absolute level best to keep inflation in check. But even if prices have stopped rising so rapidly, that doesn't mean that they're coming back down. More important from our perspective, inflation is front and center in the averages, where the inflation-addled Nike held back the Dow Jones Industrial Average, which advanced just 40 points today. S&P inched up 0.01%. NASDAQ edged 0.08% higher. Yeah, inflation is a funny beast, isn't it? Nobody wanted to claim the inflation mantle, but I think the undercurrent behind Nike's plunge into the crevasse of mixed quarters is all about inflation. It's emblematic of how higher prices are changing the face of business, and it's not changing the face nicely. Nike, under now deposed CEO John Donahoe, a former tech executive laid of ServiceNow, decided to go heavy into e-commerce and at the same time to go heavy into price increases. Probably seemed like a good idea when it took over, just as COVID sent us into lockdown. Besides, why show off your best stuff at Foot Locker and Dick's Sporting Goods? Why give them a huge chunk of a sneaker gross margin when you can capture it all yourself at Nike Direct? It's a thoroughly technological approach to boosting earnings. Just one problem. Something a shoe guy or maybe an athlete would have known instinctively. In a more frugal moment like we have now, with a beleaguered customer, people aren't paying 200 smackers for a pair of sneakers, at least without trying them on first. I say Nike meet the new consumer, the one who's had it and doesn't want to take it anymore. The consumer who feels ripped off, price gouged, and has reached the limit of what she'll pay. Unfortunately, many Nikes are now beyond that limit, especially if they turn out to be not your cup of shoe when they come in the box. Now, I know politicians are trying to cash in on this price gouging notion. Vice President Harris even proposed a ban on price gouging. I don't know how that'll work, but I do know what will work. A savvy consumer who's beginning to upset the entire scaffolding of price hikes that we've been hit with since the pandemic. Those price increases are going to have to be rolled back in one way or another, or your CEO is going to get rolled, just like we saw at Nike. I don't think it's a coincidence that another CEO, Luxman Narasimhan, late of Starbucks, lost his job during the year of the $7.25 pumpkin spice latte. That's another tripwire that the consumer wants to sever. Cups of coffee priced like their lunch. I'm seeing this everywhere. Last night, in an interview with interim CEO of Chipotle, Scott Boatwright, and the new president and chief strategy officer's former CFO, Jack Hartung, well, we discussed this.
There was a pullback from the consumer. So I think it's more of a macro resistance to inflation in general in California. But we watch that stuff very closely because it's the three things. It's, one of the three things is affordable. We're not going to give up on affordable because we don't want just some people to enjoy Chipotle. We want everyone to enjoy Chipotle.
The ubiquitous pricing issue came up again with Brendan Foley, CEO of McCormick, when we talked about the appeal of spices.
Consumers are looking for value, and we think we're doing the right things across our business to do that. Flavor is a small part of the cost of any meal, but it has such a big impact. And so we see a lot more consumers now shopping around the perimeter of the store. They're having to flavor a lot more of their meals because they're making it from, the produce department or buying new steak, and they need Montreal steak to flavor their steak. We're finding out that what's really working with consumers, particularly as they're thinking a lot more about their spending right now. They want to try new flavors. They do want to explore, but they may not want to spend as much as they would normally do. So they'll put out $1 to try a new flavor, and that's what we're finding is really working with these minis with Frank's. And so this is a small version of what we have up there. I love the creamy buffalo, and we're seeing a lot of turns from that.
I mean, come on, this is incredible. People are staying home and sampling hot sauce because they want to simulate the experience of what they used to be able to have a nice dinner away from home. It's not just too expensive to buy Jordans without trying them on. It's too expensive to regularly go out and eat at most places, with the possible exception, say, of inflation-fighting Wingstop. When you raise sneaker prices too far, your sales go down double digits. You keep prices the same, well, Wingstop, you get double-digit gains. And that's why Nike stock is down 23% for the year, whilst Wingstop is up 65%. Yes, you give the consumers a bargain, your stock soars. While everyone's mad about inflation, it's the kids born starting, say, in the late 90s who seem most angry about it. They're now part of a jaundiced workforce where they have to compete against a slightly older generation left behind by COVID. Plus, there's the prospect of artificial intelligence making all sorts of white-collar jobs perhaps disappear. The unemployment rate for working-age members of Gen Z is almost twice the national average. Some portray them as a group of daytime video gamers who like to fritter away their money on DraftKings. I prefer to think of them as people who want to be able to afford what their parents could, but in part because of inflation, they may no longer find that possible. They do what I call loud budgeting. They don't want to do it, but they kind of have to. Most companies are still in denial about pricing. When you read through the reports, say Brown Forman, the liquor company, redoubtable maker of Jack Daniels, you think it's weaker sales or some sort of kind of a mystery. But the fact is, liquor, after multiple price increases, just got too expensive, especially when you go out. I'm not picking on Brown Forman. You don't get a 22% decline in the sales of Diageo's Casamigos tequila by keeping prices lower, do you? However, you aren't going to hear Diageo say, oh, my holy cow, I mean, we took prices way too high. We better take them down now. The liquor companies are pondering that perhaps Gen Zers want to be healthier. Maybe they finally realized that alcohol is unhealthy. But higher price? Oh, they'll never make that the issue. Except it really is, because inflation is insidious and often seems invisible to the very people who've been putting through the price increases. It's a shame they're still in denial. Unlike many other companies, McDonald's was quite vocal in accepting that maybe it had taken too much price. They told it to me. They said, wow, maybe we didn't do this right. Their decision to extend the $5 value meal deal beyond the summer, well, that was very well received. And not just by Main Street, but by Wall Street, too. Do you think it's a coincidence that this stock's now run from the 240s to 303 since they decided to roll back prices for good? Those people, highest compliment. They got horse sense. Companies are so reluctant to take prices down because they don't want to hurt their treasured gross margins. But I think it may be time for a giant reset. Again, there's a reason why companies that offer real bargains have seen their stocks soar. Amazon up 22%. Costco, 33%. Walmart, the real enemy of the gougers, with a whopping 53% run all this year. Funny enough, if you keep prices low, you can indeed make it up in volume, because the consumer's a lot smarter than some of these companies are ever willing to admit. So let me give you the bottom line here. The politicians can toss invectives at each other and get on their proverbial high horses about who's price gouging, but I think we'll look back in 2024 as the year when the public took matters into their own hands and stopped buying goods with inflated prices from stores that refused to lower them. The result? Fired CEOs and crushed stock prices for all those who refused to heed the thunder of those angry consumers who finally just said no to the scourge of inflation. Zeb in Texas. Zeb.
Hi, Jim. Thank you for having me on. I'm a big fan, and I appreciate all that you do to educate us and help us win.
Thank you.
My question is specifically on Royal Caribbean, ticker RCL. Over time, I've been able to build a good position in RCL with a cost basis of less than $60. I also took some profits recently. I'm also heavily invested in NVIDIA and the whole AI trade. But I'm a bit confused where to invest, and I'm contemplating moving my money from RCL into NVIDIA. Which one of the two do you think will run faster and has more potential to grow?
Why choose one or the other? You've got a terrific, let's say, excuse me, duo of stocks. Royal Caribbean is a great play on the consumer and a terrific situation. NVIDIA? I'm so sorry. NVIDIA? Well, we just heard that demand for Blackwell is insane. So let's keep them both. I think we'll look back on 2024 as the year when consumers took matters in their own hands and actually said no to inflated prices. And the result for those who aren't listening, fired CEOs and lower stock prices. On Man Tonight, I'm checking, oh boy, I'm checking in with Cloudflare's. I work no matter what. Cloudflare's top brass fresh off the launch of new AI tool and finding out more about its role in election infrastructure with just over a month until the big day at the ballot box. Then the company behind Slim Jim and Vlasic fell earnings. Well, they saw its earnings miss, but maybe it's a chance to buy. Could be. I'm getting on a read of the packaged food space with Conagra CEO. Plus, do not miss my exclusive look at Levi's latest numbers and what a new celebrity-driven campaign could mean for this apparel name. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week, Cloudflare, the leading connectivity cloud company, held its 14th birthday event where they announced some major new products. But the one I'm most focused on is something called AI Audit. It's a tool that helps publishers get compensated when their content gets used to train generative artificial intelligence models. Right now, one of the biggest problems with AI is that these things are arguably copyright infringement machines. They scrape data from all sorts of websites while training their models. But now, gratefully and graciously and gloriously, Cloudflare is something that can help companies control their content and negotiate for a small piece of the pie. Of course, I say that as a content creator. Now, I don't know if it's going to be a needle mover, right out of the gate at least, but with the rise of artificial intelligence, it's something we desperately need. Earlier today, we got a chance to catch up with Matthew Prince. He's the co-founder and CEO of Cloudflare. Take a look. Matthew, first of all, happy birthday week. Great to have you on Mad Money.
Thank you so much. 14 years since we launched Cloudflare, and we're just getting started.
I actually think that is because the slew of products that you introduced are rather remarkable, including one I feel strongly about as a content creator. It's called AI Audit. It's the first thing I've seen. I've not seen anything like this, and I want you to please tell our audience what it might do for both the people who create content, but pretty much for everybody who scrapes the internet.
So, at Cloudflare, our bread and butter is helping anyone who's putting content online keep it safe from attackers. And what we heard from content creators, just like yourself, was that more and more they saw these AI companies that were taking their content and not giving them anything in return as an active adversary, someone who is actually stealing from them. And so we listened to those content creators and we said, first of all, we're going to give you visibility into who is scraping your content. Secondly, we're going to give you control over how they can take your content or not and give you back that control. And lastly, we're going to actually create a marketplace that allows you to actually say, here's what my content is worth. And if you want it to go into your giant brain in the sky, you've got to actually compensate for me in one way or another.
Well, this could be the end of what I regard as the great ripoff. I mean, if you're Reddit and you're creating a lot of content and it's very valuable to someone, it should accrue to you, not to the people who pilfer you.
That's exactly right. And I think that if you think about what the first business model of the web was, it was search. And the quid pro quo with Google was you let them scrape your content, and in exchange, they sent you back traffic. And you could do whatever you wanted with that traffic. You could monetize it with advertising. You could monetize it by selling products. You could just brag about the fact that a lot of people watch your show or view your content. Whatever you did, that was up to you. The AI era is different, and we haven't yet figured out what the business model is. But there's going to be money to be made, and those content creators, if they're going to keep creating content, need to be compensated. And at Cloudflare, we realized that because so much of the web was behind us, we were in a unique position to actually pull this off.
Well, I have to imagine this is almost immediate monetization because there are so many companies who desperately need this product. What has been the reception so far?
Well, I think, first of all, it's been incredible to see some of the leading content creators say, wow, for the first time, I totally understand Cloudflare's value proposition. So our phone is really ringing with other content creators who want to get involved. But we're giving these tools away for absolutely free for anyone who uses Cloudflare's platform, because we think that regardless of what your budget is, if you're creating content online, you should have that control. And over time, we think that there's going to be an opportunity for a marketplace to develop, and we'll generate some revenue off of that. But we think the majority of that needs to go back to the content creators, because if we don't have original content, then the web dies. But more importantly, maybe we don't have anything to train these models on, and none of this AI is going to amount to anything. So we need original content, and Cloudflare is going to help make sure that original content creators, just like yourself, are getting compensated for it.
Well, I've got to tell you, this was always my biggest fear. There's nothing in it for content creators, so in the end, they die. And I think that this product saves them. Now, there's another thing that you're doing that I don't think people realize how important it is, because they all take it for granted, which is speed. And I am looking at a product that you are offering, and it's called Speed Brain, which eliminates latency. I'm not sure everyone understands latency, but how important is this product for all the companies that are competing for your eyeballs?
Well, we talked about how AI is a challenge to content creators. There are also opportunities for AI to be this incredible benefit. And what we've done is we've actually used AI systems to train on all of the traffic that we see. And Cloudflare sees north of 20% of all of the web. And so we can use that to actually predict in ahead of time what someone is going to go to before they even click on the page. And that means that that can get loaded before you go there. And what it means is it's a magical experience to end users. It's a magical experience to the content creators. And in the end, it almost doubles the performance. It increases the performance of the web by about 50%, which when my team told me we were able to do this, I was just blown away. And what, again, I think is so powerful, and really the spirit of Birthday Week is this is something that is available for every single customer of Cloudflare.
Now, I want people to understand this. You basically are giving these things away. Now, most people wouldn't do that, but you do kind of want universal adoption of what Cloudflare does.
You know, our mission at Cloudflare is to help build a better internet. And so every year we use the week around our birthday, which is September 27th, to really give back what we think of as gifts to the internet. And we don't believe that, you know, regardless of what your budget is, everybody should be fast, everyone should be reliable, everyone should be secure online. And so every year our team is incredibly excited about how we give these things back. And what we find is it creates this enormous flywheel. It means that more people want to come and work for us. It means that more customers want to sign up for us. And so it's turned into what is a great business. But again, it really speaks to the mission-driven nature of Cloudflare's business. Our mission is to help build a better internet, and we're incredibly proud of all of these announcements to live up to that goal and that mission.
I want everyone to know something else that you do. And there's a great little page, Helping Build a Better Internet, as you just said, helping protect democratic elections. Vote.org, which we no matter what party, know is so important, relies entirely in terms of the safety of what we do for elections on Cloudflare.
Yeah, when we saw in 2016 that there was foreign influence that was using technology in order to influence elections. Again, regardless of your politics, we couldn't have built Cloudflare without a stable democratic institution. We couldn't have built any of these businesses without having a government that people can trust. And so our team said, we need to do something. And so we launched something called the Athenian Project that gives all of Cloudflare's most advanced tools and technologies to any state or local official who's helping administer an election. I don't care if you're in a red state or a blue state or a purple state or some green state that's out there. Whatever you are, we want to make sure that you've got the tools to be safe. And that's really important because these election heroes are the patriots of our country. They're the ones who are literally every day having to stand up to the GRU, make sure that our elections are safe. And we want to make sure they've got the absolute latest technology. And so I'm proud of the fact that we're doing what we can to make sure that the election that's coming up in the United States is one that you can trust.
Well, I've got to tell you, it's a birthday week that I think helps everybody. It's a rather remarkable thing that you gave. The Athenian Project really it is worth it to talk about because the Athenian Project is not something that would typically come up. People think from Silicon Valley. You're different. What you do is different. And we thank you as voters for what you're doing. Matthew Prince, co-founder, chair, and CEO of Cloudflare. Thank you, Matthew, for coming on Mad Money.
Thanks, Jim.
Good to talk to you. Yeah, but back in a moment.
Coming up, are investors hankering for a new recipe? Or can this stock have their cake and eat it too? Stick with Cramer.
Tough day for the stock of Conagra Brands. This house of packaged food brands saw its stock plunge 8% after the company reported a suboptimal quarter this morning. They delivered a top and bottom line miss and sales down 4%. Operating margins shrunk 250 basis points. But when we spoke with management, they told us this quarter would have been challenging. They told us ahead of time. And despite these challenges, Conagra still delivered 1, sequential volume improvement, and 2, they reaffirmed their full-year forecast. In the end, I think the stock got crushed because, well, the thing had run so much. It was up more than 15% in the last 3 months. So did Conagra shares simply fly too close to the sun, or is there something deeper that we got to worry about here? Let's check out with Sean Connolly. He's the president and CEO of Conagra Brands. Comes on good and bad times. Mr. Connolly, welcome back to Mad Money.
Hey, Jim, glad to be here.
All right, so Sean, we went over and parsed every word that you said when you were on last. You said that there would be noise to the quarter. You said that there could be some difficulties when the final numbers came out, but you would reaffirm your forecast. You did everything you said. Is that, therefore, as a CEO, not a little galling to some degree to see your stock down 8% if you did exactly what you said you were going to do?
You know, Jim, you don't last too long in these jobs if you live quarter to quarter. But while the market wanted more out of our first quarter, it actually unfolded largely in line with what we expected, which is why we reaffirmed guidance on the year. There were 5 particular positives that we were very pleased to see. Number one, our investments to return volume to growth are working. Number 2, our market shares have been excellent, both in the absolute and especially versus our peer group. 3, our cost savings programs are delivering. 4, our cash flow remains very strong. And 5th, we were very excited to resume our portfolio reshaping efforts with both an acquisition and a divestiture in the quarter. The one thing that worked against us this quarter was an unfortunately timed temporary disruption in our Hebrew National hot dog plant. That cost us some sales in the quarter, but that's behind us now. And due to the strength of our fundamentals, we were able to easily overcome that and reaffirm our guidance.
Well, let's, because I don't want to just kind of gloss over anything that did go wrong. You did say on your own call that you got a flat tire on the way to your wedding, which is what way you described what happened with Hebrew National. So let's just go over that, tell people, so people realize, listen, there was a glitch. It just wasn't anything that really is going to impact the rest of the year.
Yeah, some businesses are seasonal in nature. Hot dogs, not surprisingly, is a seasonal business. The grilling season is really Memorial Day through Labor Day. So that's when we drive the bulk of our sales. We got off to a great start at Memorial Day. We did have an issue at the manufacturing facility that led us to pause production temporarily while we fixed it. We got that behind us. We're up and running again. So it is a temporary thing. My analogy of getting a flat tire on the way to your wedding was really about it's unfortunately timed when you've got a seasonal business like hot dogs, and then you have a hiccup at that point in time.
Understood. Now, what I care about is taking share in 2 categories that are growth categories. One is snacking, which we care about tremendously because I think that snacking is one of the things you do incredibly well. But also I care about frozen because when we talk about convenience and we talk about price, frozen is the winner. So why don't you go over how those 2 are doing?
Yeah, we posted some really astounding market share numbers in our 2 key growth areas, which are frozen and snacks. 93% of our frozen and snacks portfolio is either holding share or gaining share, which really ranks favorably to just anybody you can find out there. In frozen, we are really winning with millennials and Gen Z consumers who we are seeing pivot back to what they typically do, which is prioritize convenience in their meals. We saw a little bit of a lull in that about a year ago when they were doing more scratch cooking because they were trying to stretch their dollars. That's coming back with a lot of momentum as we've launched a whole bunch of new innovation. And in snacks, something very interesting is going on. Our portfolio in snacks is focused around protein snacks, in particular meat sticks, which is the fastest growing snack subspace in the universe, as well as high fiber snacks like protein. Increasingly, we are seeing consumers pivot to these what we call permissible snacks. They're healthier for you, they're high in protein, and away from high sugar or high carb snacks that tend to be fried. So our snack business is built to win in the current environment, and we're seeing very strong market share performance there as well.
All right, so Sean, people looking at the stack of great Conagra stuff we have in front of us, they are looking for the pickleball paddles. That's not going to happen. And they say, wait a second, what is this guy talking about? I see a thing called fatty jalapeno sticks. I mean, how can that be protein if it's fat?
Well, you're misinterpreting the word. What fatty means, it's all about living large. It's really a product that was built by a professional athlete. We just acquired that business this quarter. It's incredibly healthy. There's only 1 gram of sugar in the entire meat stick, but it's loaded with protein. So if you're working out, if you live an active lifestyle, if you're looking for high protein with great taste, but really virtually no sugar, fatty is a great product for you, and it's a great addition to our extremely strong meat stick portfolio.
And I think people have to know, Sean, I mean, I know this, even Lifetime Fitness CEO was saying that if you work out and you don't have the protein, or if you have the protein but you don't work out, GLPs don't work. You have to have the protein or else you get frail.
Absolutely. Everybody's either looking to protect muscle mass or build muscle mass. And that's why we're seeing such a migration toward protein-centric snacking. And our portfolio is designed to win in that space, Jim.
It's just, I think some people don't understand the idea of what you can do with your portfolio and move it around a little, but they do care passionately about that dividend. With the ratios as they are, financial ratios, dividends fine, right? Can we do both dividend increase and reshuffle a portfolio?
Yeah, in fact, that's what we've done over time. We've always had a balanced approach to capital allocation that includes paying a healthy dividend, occasionally buying back shares, occasionally making an acquisition. Sometimes we do divestitures. So all of that's kind of in our wheelhouse, and our balance sheet is in a place now where we can get more active and kind of getting back to our normal playbook of actively reshaping. And why do we do that? Because we're trying to accelerate our growth profile and improve our margins, and that's what the reshaping is all about.
Because you know this business so well, I want to bounce a theory off you. These Gen Z people, they're a little squeezed. There are a lot of people got laid off during COVID. They're competing against different cohorts. Secondly, they don't have that level of surety in life that you might have, or I don't want to say optimism. That's too difficult. But they seem to want to hunker down a little more. Are you seeing people still willing to, those people still staying at home, cooking or buying frozen, rather than going out and spending a little more money than the other generations?
100%. In fact, the fastest growing demographic for our company are those younger consumers. And there are two really important data points that I see when we study them. Number one is they're actually eating out less, so they're eating more at home. Right. And number two, they're looking for quick meal solutions. They don't want to spend a lot of time planning for meals, prepping meals, cleaning up meals. They want a quick solution. That's why our frozen single-serve meal business is such a winner with that demographic.
Well, I got to tell you, Sean, you've always been a truth teller, and I understand and welcome back the idea that you can do the kind of reshuffle that I really love that ConAgra does. And I hope people understand a little better what really happened this quarter, because I know that you delivered on what you promised to our Mad Money viewers. Thank you, Sean Conley, CEO of ConAgra Brands.
Thanks, Jim.
Absolutely. Mad Money's back after the break.
Coming up, do the earnings show a healthy demand for denim? Or should this icon pivot to a new strategy? Cramer's got the CEO next.
All right, what do we make of the numbers tonight from Levi Strauss, iconic maker of all things denim? Tonight, Levi's reported a minor sales miss paired with a 2-cent earnings beat off a 31-cent basis. They did cut their full-year revenue forecast, even as they believe their full-year earnings will come in near the midpoint of the previous guidance. When you look at the when you look at the quarter in entirety, let's call it mixed. Europe's strong. Asia and America's weaker. Direct-to-consumer business doing great, up 10%. Larger wholesale struggling, down 6%. In short, we need some more clarity. So let's go straight to the source with Michelle Goss. She is the president and CEO of Levi Strauss & Company. We'll learn more about the quarter. Ms. Goss, welcome back to Mad Money.
Hi, thank you, Jim. Great to be here.
Okay, so Michelle, once again, I like many people, are trying to parse things. And we don't want to jump to any conclusions because we could say, wow, DTC is on fire, but then we worry about wholesale. How do you make sense of the mosaic that was just delivered?
Yeah, you bet. So first, let me kind of share the numbers. When we look at our business on an adjusted basis, which includes our exit of the Denizen business, our business overall was up 3%, which is an improvement from the first half of the year. And when you look at the Levi's brand, that was actually up 5%, which is the strongest it's been in over 2 years. That being said, we did see some headwinds and a couple areas that did not meet our expectations. And that was around China, Mexico, and Dockers. And each of those created headwinds for our business. So if we start with China, I would say that we had our own executional issues. We're addressing that. We've put new leadership in the market. And clearly that was exacerbated by what's happening in the macro environment. With Mexico, a big piece of our business in Mexico is actually wholesale. Like China, we had some executional issues. We're addressing that. But the biggest thing we had was one of our key customers, one of our top customers, had a cybersecurity breach, which impacted our shipping. So in both of those, we have actions to address. And then on Dockers underperformed. It was down 13% in the quarter. It's underperformed for some time, and we've made a big decision, which is to explore strategic options with the intent to sell the business.
Oh, I think that's great. I didn't want to have you another quarter and say, all right, what are you doing with Dockers? I mean, you have to address them. You're taking biting a tough bullet. I do want to go back to Mexico for a second. I don't think people realize how there's a lot of companies that have business in Mexico. Mexico is a huge business for you. So a cybersecurity breach could actually have reduced these numbers more than people who are trading on the stock right now and sending it lower.
You're absolutely right. I mean, it's a very big business for Levi's. It has incredible brand strength for us. And I would tell you, the brand continues to be strong. Our direct-to-consumer business there in Mexico also was up double digits. So we can isolate this to a wholesale issue. And like I said, and the biggest thing was this issue with a top customer. It's being actively addressed. And we do expect sequential improvement, Jim, into the fourth quarter and into 2025 in Mexico in particular, and candidly, like our whole business. Yeah. And while, to your point, we had strength in the Levi's brand up 5, a couple of these headwinds, we're expecting sequential improvement into the fourth quarter, being up mid-single digits and carrying that through into 25.
All right, that's terrific. That's much better than I think people are thinking about. Now, I do want to talk about something that I'm very excited about. Frankly, you can tell me otherwise, but I think Beyond Yoga, I've been waiting. I used to talk to Chip, your predecessor, Chip Bergman. I said, come on, Chip, you can take this brand somewhere. Well, we're getting double-digit growth. What can happen here?
It's a big opportunity. I mean, it kind of goes back to the portfolio now with leaning in and sharpening our focus on Levi's and also accelerating Beyond Yoga. We brought in a new leader in Nancy Green. She's brought in retail and apparel veterans, and we're just in the early stages of this, 19% in the quarter. But this business can be $500 million or more, and it's a category that is expected to grow over time. So, I'm thrilled that the brand was acquired a couple years ago, and we're just in the early stages.
Now, I don't want to bury what many people would think is the lead, which is the Levi's brand today announced a new campaign. This is as of 2 days ago. Global icon Beyonce following do I have to hear this one more time in my radio, my Spotify with my wife, Cowboy Carter? Tell us what this could mean, because what a spokesperson.
Yeah, incredible. I mean, Beyonce, she's a global icon, right? She's an artist, she's a fashion icon, and really to bring Levi's, which is also an icon with Beyonce, we think this is going to be a really powerful partnership. And to your point about the song, I mean, this builds on decades of a relationship with Beyonce. She's been a fan of Levi's, we've been a big fan of her, so it was really a natural evolution. And as you were just talking about the Levi's business, a real big bright spot, Jim, is women's. Levi's has been talking about women's for quite some time. We see this as growing to at least half of our business, doubling over time, $2 billion even just this year. So thinking about all the innovation we're bringing with women's, fashion bottoms, loose and baggy, head-to-toe denim, and now you bring Beyonce into the ecosystem, we think we're just set up for the long term really, really well. We're so honored to partner with her.
Even though I know a lot of people will come and say, listen, we're nowhere near the holiday season. When it comes to apparel, the holiday season's already arrived. Will you have everything in the stores you need with Beyonce for the holiday season?
I love that question because as you saw with our first chapter with Beyonce, this is about Beyonce with our iconic products. I mean, she's wearing the 501. And while we are really excited about the innovation we're seeing in denim and fits and head to toe, our icons continue to perform. 501 was up over 10% in the quarter, and that's been many quarters in the making. So with Beyonce wearing the 501 with the essential tee, more chapters are coming with her. And I just think we're set up overall for the holiday season. I mean, as we've shared, we're expecting mid-single-digit growth for the holiday season and expecting to, end the year stronger than where we started. We have great product for men, for women, for gifting, for self-purchase. So we're leaning in and fueled by the strength in our DTC business. As I said, up 12% globally, up 12% here in the US. So I'm excited for retail. Like, this is our Super Bowl, the holiday season.
Now, one last thing. DTC, we had a really great company, Nike, not have good DTC. And a lot of people are concerned, well, maybe there's a price point where you have to try them one. You're not going to spend $200 to do a DTC. Do you think it's one of the reasons why Levi's works? People know their size, and your price is very reasonable. Is that why DTC is so strong?
Yeah, I mean, I think for Levi's, we are such an approachable brand that addresses all demographics. And so all channels have their place. And when we talk about being a DTC first company, it's really DTC plus wholesale. And wholesale amplifies our DTC first strategy. We reach millions of consumers in wholesale, and even in that channel, which, was negative again this quarter, we saw improvement. It was down 3%. We expect sequential improvement over time. But, the fact is that you can buy your Levi's in a great wholesale partner, and they're really important to us. Or when you come into our stores, you do get the full assortment of Levi's. It's also worth mentioning, Jim, that, not only is our bottoms business strong in DTC, but our tops business. Our tops business for the company was up 8%. And even stronger in direct to consumer. So as we think about Levi's not just being the best pair of jeans on the planet, really becoming a head to toe denim lifestyle apparel company, I think we're seeing the proof points. And we expect us to accelerate into the fourth quarter. All
right, good. Now, I hope that yoga keeps going well, and we do not have to talk about Dockers after this. That would really be a great privilege. Beyonce, yes. Dockers, no. Michelle Goss, CEO of Levi Strauss, thank you for coming on.
Thank you, Jim.
Mad Money's back here for the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Good back to our reporters going to name this talk to us. Bye. Tell us what's going to the call start. We plan us out. And then the lightning round is over. Are you ready, Ski? Dad, time for the lightning round. Let's start with Trey in Texas. Trey.
Jim, I was brutally denied a banking job a few years ago with the director saying he, quote, feared I lacked the intellectual horsepower necessary to succeed in their world. Sadly, I figured I'd show him as I went all in on Peloton at $155 a share. Maybe he was right, Jim. Down 97%. There's really no reason for me to sell this. Guess I'm just wondering if I should hold my nose and buy more.
First of all, you got to pick yourself off the dirty linoleum floor, stop drinking that cheap scotch, and take the loss, because it's worth a heck of a lot more than the potential gain of $1 more when someone figures out we'll just pay $2 billion and buy the whole company. Sorry it didn't work out, but I still don't like that banker. Let's go to Paul in Massachusetts. Paul.
Jim, how are you, my friend?
Oh, I've never been better. Thank you for asking.
Big fan of the show. Listen, I'm an investor in NIO, the China competitor to Tesla. Took the position about 3 years ago, pre-pandemic, and I paid about in the 40s for the stock. It's taken a massive nosedive over the past several years, as you've known, but I've held on, and it's
I want you to hold
nicely.
on. You know why? Because my friend, buddy, pal, Dave Tepper says you want to buy everything. And I'd never been wrong betting with Tepper. Let's go to, except for when the Eagles played the Panthers. Let's go to Tyler in Georgia. Tyler.
Hey, Jim. Booyah from the state that built the majority of your Eagles defense. Go Dogs. Hey, my question's on a company that you've had on the show as a darling of the dance many times. But since Susan Solka has left as CEO, the party seems to be over. How do you look at and trade Amen Healthcare from here?
I feel the same way you do. Ever since she left, the party's over. Now, of course, labor costs are not good, but she had control over these things, and I don't think the company's doing that well. It's about doing as well as those Georgia fellas that you sent us from the defensive line. Let's go to Daniel in New York. Daniel.
Hey, Jim.
Daniel, what's up?
Second time caller. It's the Cutco guy.
Oh, yeah, right.
How are you? Look, seems like no one on social media ever loses money in the stock market. I want to be authentic with you. I have the misfortune of owning Humana. It's miserable. It's a disaster.
Yeah, I was talking with Jeff Marks today about it. We were lucky enough to be able to get out before this just brutality You know what? If you can't price the product, get out of the business. Sorry, that's the way I feel. Let's go to David in California. David.
Hey, Jim. David from Escondido. You and I, you don't know this, but this is our silver anniversary. So I'm calling you because I've been watching you since 1999.
Oh, man, that is fantastic. That's fantastic. Congratulations. What's going on?
The only thing I would say is that your parents misspelled your name. It should be G-E-M because you are special. I'm telling you.
Hey, you're a good guy. You're a good guy. It's been a tough day. Thank you for that. Good.
All right, I've owned SciTime for a little while, SITM, and I'm wondering if I should double down or hold off.
Just hold it. We had SciTime a long time ago. I didn't want to kind of put them on. I said, no one's ever heard of SciTime. Then I had them on. I said, oh, what a good story. Let's hold on to it. It's a good story. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Only on Wall Street will people worry endlessly that things are too good. Right now, we have a host of things, frankly, that are going incredibly well. And so many people think they're just too good to be true. I get where they're coming from. But you know what? They're wrong. For example, we have two different candidates for president, both of whom are offering tax and spending plans that would take a ridiculously large budget deficit and add trillions to it. And what happens? Long-term interest rates, the ones not controlled by the Fed, are remarkably low, with the 30-year Treasury at just over 4.1%. I can recall moments when the government had a surplus, like 2001, and the 30-year traded at 5.4%. I know it seems insane, but no one seems to acknowledge that we've got an incredibly positive anomaly on our hands, although maybe anomaly is the wrong word. The bond market only seems to care about the deficit when inflation's rampant. But now that inflation's been mostly tamed, the deficit's a non-issue again. Now, you can say the markets are totally wrong, but trillions upon trillions of dollars worth of bonds are trading at those levels. So how wrong could they really be? Oh, and if you think it is all about one giant fake out, well, you can sell your bonds right now. Yet we're constantly told interest rates are going to soar because of the deficit. Other than 2022 and 2023, that argument's been dead wrong for decades. What else? When there was a major regional war in the Middle East 51 years ago, Saudi Arabia they actually quadrupled the price of oil for Americans in order to punish us for supporting Israel. Now, Israel's fighting a two-front war and trying to decide whether to declare war on Iran, too, after that ballistic missile attack. But the Saudis are talking about how oil's going to fall to $50. That's $20 below where it is now. That's right. It's a subtle gambit that suggests that even if Iran's 4 million barrels per day of production gets shut down, the Saudis will make up the difference when the price of crude would keep coming down. I mean, remember, Saudi Arabia hates Iran more than it hates Israel. So rather than what we had in 1973, we've got the opposite. Now, how is oil about to have a huge spike when historically the Saudis are telling us it's going to go lower? This may be a bad case of fighting the last war over again. We have a Chinese economy that's on death's door, right? Perhaps the weakest major economy in the world. And I'm including Latin America here. Yet the Chinese stock market has absolutely exploded because the Communist Party decided to move it higher. They have sanctioned. No, they've demanded higher stock prices to stimulate the economy. Normally, you think stock prices would go up in response to stimulus. So the PRC has put the cart before the horse. I say, so what? It's a dictatorship of the bullish proletariat. Yet we're constantly told that this Chinese rally is dead wrong because it's totally divorced from reality. To which I say, hey, if you got a command economy, you can create your own reality. If you want to buy a share of Alibaba, it costs you $115, phony or not. So what if the company isn't doing any better than it was when the stock was at $77 2 months ago? No market's perfect. Or how about the price of the very private OpenAI, which just raised $6.6 billion at a valuation of $157 billion, even as it's expected to roughly lose, say, $5 billion a share? Does anyone say, you know what? I think this company, which has completely revolutionized the world, actually has a pretty good price here, especially when you consider it as 1,700% revenue growth? No, all we hear is how it's ridiculously expensive versus those losses, and who would even want to participate in that lunacy? Well, how about you and me? But they won't let us. All I can say about these wonders of Wall Street is that they aren't wonders at all. They're what people are willing to pay, whether we're talking about bonds or oil or stocks or private valuations. Maybe we should stop querying. Maybe we should stop bemoaning. Maybe we should stop sardonically denying reality and instead do something radical here, like accepting the truth. Because like it or not, these prices are self-evident and they should be considered truthful at least until proven otherwise, which doesn't seem likely to happen anytime soon. I like to say that there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you next time.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.